Good morning, everyone, and welcome to the CBI at 10. About a year ago, as we got started with these CBI conversations focused on the coronavirus, perhaps there were two real areas of conversation. One was around what's closing down, and the other was around financial support. And as the CBI weighed in with government and business to try and work out what packages of financial support would work, there was always this question, which was, well, what's the world going to look like a year from now? In the spring of 2021, when the daffodils come up, is British business going to be blanketed in debt? And the conversation that we're seeking to have today is to try to understand where business stands now, which businesses still need financial support, and what are the consequences for those businesses that have taken them. And we're really lucky that we've got quite a group of people who understand the complexities of these issues in Flora Hamilton, who is in charge of financial services at the CBI, Alex Beardsley and Stephen Pegg. I'm going to come to you in a moment too, but I'm going to kick off, if I might, with Matthew Fell, the policy director, because Matthew, before we get sort of into the financial issues, there are quite a lot of other moving parts this week around travel and quarantine. So should we just touch on those, and then we'll get stuck into the financial support issues?
Terrific. Well, thank you, James, and good morning, everyone. James, as you say, I think we're now sort of working through at reasonable pace, actually, the various reviews in the Prime Minister's roadmap. And we spoke last week about our inputs to the COVID secure working guidance, where we're emphasising the need for sort of clear legal status, the interplay with some of the testing and vaccine, and consistency as much as possible. Last week, the deadline was to get views into the Department of Transport for this global travel task force, the really important piece around international travel. And a few of the key points that we made to the department there. One is that we're getting behind a sort of risk-based approach, so making travel possible for lower risk countries as soon as possible. Second, that really we just need really simple and effective border arrangements. So testing and checks happening upstream wherever possible, making sure that arrivals are segregated if people are coming in from lower risk countries and so on. Third, that it needs really good communications, and a key point here, as much notice as possible for operators in terms of when the opening is going to happen, and also if restrictions are going to change and tighten and so on, making sure there are those lead times so we don't have those big dash for the border that we saw back in the summer. And also an opportunity, I think, for the UK to show real international leadership and help that coordination effort on what is clearly a really sort of global topic. So that's another one of the roadmap reviews we've managed to tick off, and we'll be pushing those points with government in the coming weeks. And then, James, testing continues to be a dominant theme for us, and we're hearing that more and more businesses are actually registering to be doing that workplace testing. The numbers of those are going up and up. But actually, a really important bit of feedback we're hearing from some sectors, including retail, is that logistically doing that workplace testing is quite tricky in some workplace testings. And they're saying, look, we're up for this, but it would be so much easier if we could get kits out to employees to do home testing before they come to work, so that we can process those in that kind of setting. So we're talking to the Department of Health and others around that possibility this week, so we'll see what is possible if we can unjam that. So those are some of the key developments on the non-finance front over the past 7 days, James. I think maybe just a quick word from me to frame the discussion today. As you said, right back at the start, we worked really hard and worked with the government, I think, in terms of speed and scale of some of those loan schemes that were out there, the business interruption loan schemes, regular businesses, large businesses, the bank-to-back loan schemes, and so on. And there's a huge amount of lending now out under those various schemes, over £70 billion worth to some 1.6 million businesses. We're now, for me, at that pivot moment that you described, some still in need of support while they're still closed and awaiting reopening, but more and more thinking around the future now. How do we get back to managing those debts and simultaneously driving growth? So there's a really important judgment moment to get the balance right on that. We've got some measures already being touted around and ideas in place, some new schemes, Pay-as-you-grow, where people have got opportunities to defer some of those payments. The recovery loan scheme has been announced and will kick in at the beginning of next month. That'll have a little bit more flex around it in terms of the type of finance available. And we're going to hear from Flora, from Alex, and from Stephen on all of those over the course of this morning.
Okay, Matthew, thank you. I mean, one thing I should have said right at the top is, of course, that one of the purposes of these CBI 10 calls is that we hear from business. So even as we're talking about UK finance, I know there is quite a lot to chew through for companies in terms of this testing issue, what you can do at home, vaccines, so please do weigh in on the chat. And of course, the really useful thing about these calls is, even as we talk about finance, we know that there are people with very specific concerns. We've got some real expertise in the digital room today. Please do just raise a question. If you want to do it anonymously, I'll try and weave it in anonymously and try and bring it into this discussion. And even if we don't make it into the discussion, I know the CBI will get back to you on the point that you raised. So Flora, can I ask you just to help us through this to start with? I suppose that if you think back a year ago, certainly by the time you got to sort of April, early May, you could really hear from the businesses that were struggling. We knew that for some people, for example, the CBILS weren't working. We heard about what was needed in the short term from small and medium-sized enterprises, what companies were working at the higher end in terms of lending. A year on, can you give us a sense, if you like, just to colour in what Matthew just said, £73 billion in lending to 1.6 million businesses, which businesses are finding that they're properly resourced in terms of access to finance, and which ones do you think are really struggling now?
Yeah, thank you, James, and great to be here, and really hoping we get lots of debate and dialogue and questions coming through to help us fine-tune our work. Yeah, we're almost a year on, and we have to remember that these loan schemes, these COVID loan schemes, were developed very, very quickly with great speed. They needed quite a number of revisions, but sterling work by the team at UK Finance, British Business Bank, CBI, FSB, everybody worked together so hard, and the collaboration was superb. We're 11 months on. We're going to start getting in quite soon into the repayment time for some of these loan schemes. That's the first thing we have to bear in mind. I think the other factor we also have to bear in mind in terms of our landscape, we've got an awful lot of first-time borrowers in these loan schemes. These are businesses that have traditionally been non-borrowers of finance, but COVID has forced them to go out there and use these loan schemes to keep their businesses going, to keep good cash flowing through them. So they're the first two things. And I think Matthew put it very well. We've got two challenges here. We have to help these businesses with their repayment strategies for this debt. And then we also have to figure out how to finance them back onto their feet again and back into growth stage. So there's two very different aspects going on here, and it'll really depend on the firm, and it'll depend on this and sector is very important, as we know. We've had businesses who've had no revenue for 12 months now. We've had businesses that have had to open up twice and shut down 3 times. So it really depends where you are and how your ability has gone and the supply chains you're within. So it's a real plethora of scenarios out there that we're facing into. And again, I say, keep dialoguing to us. We want to know those scenarios. We want your case studies. Keep talking to us. The intelligence we've got from CBI members has helped us to liaise and to get things into the best shape we can do, to get the right policies on the ground. So that dialogue's critical. So let's look at repayment. A couple of minutes on repayment. So we've got Pay As You Grow, which is designed to be the next stage for the very, very successful bounce back loans. And it is basically a very formal framework that has been set up and designed by government with British Business Bank and UK Finance. And it's going to basically tackle in some of the concerns we have about the ability to repay. There will be extensions from 6 to up to 10 years. There'll be an ability to take a payment holiday. There'll be up to 3 times, I believe, to actually fall onto interest only. So there's quite a bit of flex in that framework for those businesses who've taken bounce back loans.
And forgive me for interrupting, Pay As You Grow applies to which loans?
The bounce back loans, that is the loans up to £50,000, and they're the lion's share of the loans. Yeah.
But not to any of the CBILS.
No, on the CBILS loans, There is a facility for forbearance, but it is not a formal framework and it is at the lender's discretion. So that is it, but it is permitted. The forbearance is permitted, but it's very much a conversation with your lender and working that through. And again, any case studies coming through on that, difficulties, do come in, let us know. So that's what we've got in terms of supporting businesses into that repayment stage. Then the other big announcement in the run-up and formalised at the budget is the recovery loan scheme. And this is to help all businesses impacted by COVID, and it can be used for any legitimate business purpose. You can use it to improve your cash flow, your liquidity, you can use it for investment, you can use it for growth. And it is designed for those businesses that already may have COVID loans, whether it's bounce back CBILS or large CBILS, and it can be taken alongside them. And it is also the replacement for the pre-COVID enterprise finance growth scheme. The features of this scheme, and this is what we're looking at, it's a hybrid model. It's getting us on that journey back into business as usual lending. So there is a facility of up to 10 million per business. There's no turnover limit on that business, so you can see the stretch of it. There'll be a wide variety of financial products that will be available across, and the terms will vary as per the product. But the two key differences to note from the COVID schemes are that interest and fees are to be paid by the business from the outset, and credit checks will apply, and of course they'll vary by lender. And those two last features tell us that we're getting on that journey to that pathway back from extraordinary COVID lending to more market-based lending, and that's very important. The overarching concern we would have, James, and I think it's important to put this on the table, is that this is a loan scheme that will work for businesses that can take on more debt. If their balance sheet can support more debt, then this is a good route forward. But of course, there are many businesses within some of the sectors where there is no facility to take on further debt. So these firms are going to have to now give serious consideration to finding equity finance solutions to achieve recovery and get back on the journey to growth. And that's the piece of work that we're all working on extensively to find what are the right regulatory fiscal policies that could support that, and to see more businesses looking at the equity finance solutions.
Flora, thank you. I want to come back to some of those points, not least for those businesses. I can see Peter Buchanan, for example, in the chat has raised a question about if you're in one of those sectors where things are going to get back to normal at the very, very end of the queue, what happens, and you'll need to find out. But I just think it'd be worth certainly trying to understand a little more deeply this pay-as-you-grow scheme and the implications of it. And we're lucky to have Stephen Pegg, who's the managing director of UK Finance. And Stephen, I think you're left holding the baby, or at least certainly the banking and finance industry is in a good deal here. Can you just explain what does this in effect mean? Firstly, for the business, but then also for banking and finance. Presumably, for a very, very long time, these loans are not going to get repaid. About bounce back.
So the way that bounce back loans worked is that there are no payments at all for the first 12 months. Yeah. And this gives you some flexibility to take advantage of more options for the rest of the term. So at any time, you can take another 6 months with no payments at all. You could do that immediately. So effectively, that means that you'll not have to make your first repayment for 18 months. The period where there were the highest number of loans drawn down was the early summer. So, we'll expect, therefore, people to kind of be opting in for that if they're really not getting back to usual, early doors. Then they can take, as Flora says, other elements of flexibility, including extending the term or having interest only payable 3 times for 6 months at any stage during the loan. So they're very generous opportunities to kind of have a bit more breathing space, which some I think will take up. What does it mean for those particular businesses? It may mean that they can free up a bit of cash flow to just keep going. They may well want to restock, adjust their business, get going again, and actually having the air time and the room to do that will be useful. For the lenders, it means actually that given that it was so concentrated, the period of initial drawdown in the summer, where there are a lot of businesses that might be in financial difficulty, that period is going to be spread out over a couple of years. And so I think that's probably helpful in order to sort the wheat from the chaff effectively. So, there will be some businesses which genuinely are not viable and will need to wind down, others which actually just need that bit more time. So I think that's very helpful. It's important to understand, though, that this is product flexibility. It isn't counted as forbearance. It won't be an automatic flag that is registered with your credit reference agency that will count against you. Taking up these options is something which you can genuinely opt into without too much of a worry. And of course, if you're just delaying the inevitable, that might not be a very sensible thing to do. By the way, to access it, the lenders will contact you. So lenders are starting to write out right now, 3 months ahead of the first loan repayment being due, to give people more information on these options. They'll have online processes to deal with them.
So, Stephen, because I suppose I'm a little confused, because on the one hand, you have the Chancellor announcing in the budget that he's going to put £100 million into HMRC, employ 1,000 people to, investigate fraud around bounce back loans. On the other hand, Pay As You Grow, as I understand it from you, not only gives you flexibility, but gives you cost-free flexibility, i.e. there's not going to be a damage to your the broader credit ratings of your business. Is that right? If you take up any of these measures, it's not going to have an impact on the standing of the business.
So I think the important thing to understand about the fraud and economic crime, which is always a risk for a large-scale scheme, is that a lot of action's been taken over the last year by lenders in preventing that. We've seen billions of pounds worth of potential losses having been prevented, but some undoubtedly will get through. That's always the case, and there'll be investigations of those. But they're a real minority. I think the bigger risk is just the credit pressure on businesses to repay, which, given their businesses are not back to usual, right, they won't be able to sustain. I don't think many genuine fraudsters are going to be making contact with their bank and asking for pay-as-you-go flexibility. If they've kind of stolen the money and gone, you're not going to hear from them again, frankly.
Right, Alex, can I come to you? Beardsley, I wonder whether Alex, thank you for joining us. I know you're the joint managing director of ABL business, and so you must see quite a good deal of the sort of businesses that are facing pressure. I'm just intrigued to know, will you give us a sense of which businesses are facing the greatest pressure? Is it from the repayment, or is it from not having enough access to finance right now?
I think it's really, really difficult to say which. There's not one challenge that any business is facing, because actually, as both Flora and Matthew and Stephen have alluded to, it's not linear. There's a real polarization between how businesses are affected and what finance they've taken. There are some businesses that have taken the government lending schemes and it's still sat there in bank accounts, waiting to be spent for a rainy day. There are others that have run out of it. And the implications, that there are personal tax implications that business owners could face. There are so many issues. And going back to Stephen's remarks about the Pay As You Grow scheme, we've looked into the detail in relation to the Pay As You Grow, and whilst it won't affect a business's creditworthiness, any business that potentially looking at it to improve their cash flow over a 10-year period wants to do so with caution, because it says that it won't affect the creditworthiness of the business, but it may affect that business's ability to go back to their primary lender who lent them the bounce back loan and have access to finance going forward. So if that's with their bank, then it may stop them from looking for future growth finance or support with their bank. So it's quite complex. It was quite easy that businesses came into this. There was the bounce back loans and there was the C-bills, but coming out of it, it's a really, really complex situation that we're all going to have to work together to understand and support businesses.
Alex, so can we just stick with that particular point? So I'm confused now. On the one hand, it's not going to impact your credit worthiness, but it might impact your lender's future willingness to lend. Is that?
Yes. So for example, if you've taken out a bounce back loan with your bank and
Yes.
you've taken it out over a 5-year period, then you're going back to ask for a 10-year revised payment profile. What you're saying to the bank is you can't afford to repay that funds right now, and you are taking advantage of what is a great scheme if you can't afford to repay those funds. However, as we've seen with bounce back loans and C-bills, businesses look at using these facilities for the best way that the business can use them, but they may be looking at using it to help with working capital and cash flow, so reducing their monthly payments but paying back the loan over a longer period of time. But actually, if they do that with caution, they need to understand that if they're looking at potentially growing or going back to their bank in the future for any growth lending, that it may have an impact on the ability for the bank to provide them with funds.
Stephen, can you just explain that? Because that doesn't seem entirely fair, does it, on businesses? If the government's back the bounce back loans, if they're the ones that are mandating these terms, that you could be doing something which is simply a response to the nature of the economy we find ourselves in now, but in 3 years' time, when things are back to normal and you've got ambitions, you're not going to be able to access finance.
Yeah, I mean, it's always the case, isn't it? If you've got a good track record of having made regular repayments on a facility, that will stand you in good stead for borrowing more money in the future. So, you know, that will be visible and will be part of a calculation. What I'm saying, I suppose, is that it won't be regarded as default or forbearance formally, because this is a product option that you're taking. There's a slight difference with CBILS, so we should make a distinction there. The coronavirus business interruption loan, which is for slightly larger loans, where you don't have these pay as you grow options. And the government have said, if a lender wants to extend the term of the loan, and they can potentially, that's got to be used only in circumstances, as Flora says, where genuinely you can't afford to repay it over the existing period. But, you know, with this lower level of repayments, you could make that payment. And I think in those circumstances, you know, that will certainly, as Alex is indicating, be a bit of a warning flag that this business is probably borrowing as much as it can afford to do so. But what we're talking about here, I suppose, is the back end and a transitionary period from, financial support to help businesses through a really interrupted period of trading, getting back towards more normal circumstances. And I think many businesses, as we've heard, have also built up those reserves and deposits and may well have cash. So they may choose to use some of the funding to pay down their loans, or indeed, use those deposits to invest. But that's the kind of next question as to, notwithstanding financial difficulty, how ready are we to kind of get back to investing, growing, driving the recovery?
Stephen, thank you. Flora, I just want to pick up on, I'm keenly aware there are going to be some businesses who are listening in or on the call and thinking, you're in a different universe. You're talking about businesses that are beginning to get back to work and managing their finance, and there are others for return to a normal working life, a normal working pattern back is months away, possibly not even into 2022. What do you think about the recovery loan scheme and the terms of that for businesses and not going to see their normal markets returning for quite some time?
It will really depend on the state of the business and how much more debt they can take on. I saw the question that came in where someone was inquiring about an uplift on bounce back from 50 to 100. Well, technically, if your business can sustain the debt and you've got a bounce back of the maximum at 50,000, then you can go in and get the recovery loan scheme. The recovery loan scheme is designed to support businesses who are already on the COVID schemes alongside it. So that is there, but it is absolutely...
Sorry, Flora, sorry, forgive me, sorry, my apologies. Flora, the difference though is that, if I understand correctly, on the recovery loan scheme, you're not getting the same terms as the bounce back loans.
No, you're not.
That's essentially a much closer to a commercial loan.
It's much closer to a commercial loan, and you've got to pay the fees, the arrangement fees. The banks forwent their arrangement fees on the COVID loans. Government didn't have to pay for that. The banks just let that go. So you're back into more. So it is going to be a more commercial term loan facility. If you need something to go alongside the existing COVID, then that is what it's going to be. But as I said,
forgive me just for understanding. So let's say, because we've got a question, and just so everyone's on the call is aware, there's a question from Peter Buchanan who says, we're in the international travel sector, which clearly is going to be the last sector to fully open. We've survived this long and desperately need some extra targeted help to keep going if the restrictions on us will continue. Can we extend the bounce back loan, as you say, to £100,000? If they go into the recovery loan scheme, what terms will they get?
It will depend on their lender. So I mean, and the details of the recovery loan scheme are still being ironed out between the great work that Stephen and his team are doing with the British Business Bank and with Treasury. So so it really will depend on the lender. I would suggest that maybe we come into Stephen on that to give some thoughts on this. He'll be closer to the work that's going on than I am at the moment.
Okay, Stephen.
Yes, what's been interesting about the new scheme is whereas at the moment, if you have a bounce back loan, you can have no other government guaranteed loan. And once you've borrowed your 50,000 or maximum of 25% of turnover, you kind of, you've done it really. Yes, you could probably get a little bit of commercial finance alongside it if you want to, but that may be difficult. With the recovery loan, you don't have to repay your bounce back loan. This can be an additional loan on top of it, but it will be potentially at a higher rate than 2.5%, depending on the risk of the business. Having said that, all lenders are required to pass on the benefit of the guarantee in a lower rate than they would lend for an equivalent loan on a commercial basis. So there will be some kind of cost advantage to doing that. And in reality, as you say, you know, there will be those businesses that do need further funding, and you know, in those circumstances, as long as there is confidence that they will ultimately get back to business as usual and be able to repay the borrowing, you know, there'll be commercial lenders who'll be interested in looking at those propositions, potentially with the support of RLS.
Okay, Matthew, you wanted to make a point.
Yeah, thanks, James. It was just on this point about the question that's come in from the aviation sector, but also those businesses that are sort of closed for longest and under most duress. I would say, you know, while we're focusing on some of the loan schemes and how that shapes up in the future, for me, those businesses, the targeted support that's going to be required is actually more in the territory of sort of government grants, the ongoing furlough support, cash flow measures around rates and things like that. You know, if you're in the situation where you're still really closed, I think, you know, those businesses are probably the ones that are going to be most loaded up in terms of the loans and the debt that they've taken on. So I think message from us is it's just really important that that kind of support continues for as long as restrictions apply on those kind of sectors.
All right, I'm going to, this kind of sort of slightly veers now into the sort of the pub quiz section of the conversation, because there's so many rather specific questions, but I think they're really worth going into. So Alex, if I might, there's a question here about whether there's any benefit, it's from Alex Milligan, whether there's any benefit to using a C-bills to pay off current loans as the interest rate is more favourable. I'm not even sure whether that's possible, but is that something that you can do?
It's something that can be done with your bank, dependent on if you lending is with the bank, then you can look to raising a C-bills to pay off that existing debt. However, it's much more difficult if the debt is with alternative lenders already, because it's not really to be used for debt consolidation, it's to be used for business interruption. And time is running out. You know, C-bills applications end on the 31st of March.
Right.
So really, in that instance, we're asking businesses to look at all of the options available. You know, loans have overtaken the lending market over the last 12 months, and there's a whole market of financial products out there that have been out there and also have CBILS attached to them at the minute, you know, asset finance, invoice finance, and businesses that actually went into the pandemic with these facilities in place came out of it actually with more cash headroom within those facilities and didn't have to take on as much debt. So it's useful to advise businesses to look at all of their options, particularly now, rather than just focusing on CBILS. I think Stephen can help support that.
Yeah, I think Alex makes a very good point there, that if you actually look at the flow of lending now, there's more commercial lending, normal commercial lending going on than government guaranteed lending. There's more CBILS lending than bounce back loan lending. So there has been that adjustment back towards various different options. And I think it's going to be really important for this recovery stage that we are using the diverse range of products and solutions, but also lenders. So, you know, they're less crowded out, as it were, than they were in the early stages of bounce back loans. The important thing is, if you've got working capital needs, actually trade finance, invoice finance might be a much more suitable product than a loan with a fixed set of repayments coming in every month, particularly during a period of uncertain trading where you need that kind of support. For longer term funding, where you might be quite heavily leveraged, then, you know, I think, as Flora mentioned earlier, considering some equity as part of that for medium-sized businesses is also going to be very important. But undoubtedly, there is going to be a bit more of a mixed economy going forward of funders, and that's a good thing, because it provides more choice, more flexibility, and more competition ultimately.
Stephen, can I just follow up? There's a question which is in line with the discussion we were just having about the cost of the recovery loan scheme, the cost of businesses. And Paul Wellham asks about the pre-pandemic scheme. He writes, the EFG scheme had a premium paid by the borrower quarterly, I think, and was as a result quite expensive borrowing. Does the recovery loan scheme work on the same basis?
No. So there's a fee payable, but the fee is payable by the lender.
Right.
And that was the case with the existing loan schemes as well, that the lender pays rather than the customer. Now, you know, that could be factored into the price somehow. You know, so you get a benefit as a lender from having the guarantee, which reduces your potential loss, but at the same time you're paying a fee. The net benefit is something which should be passed through in a slightly lower rate. But no, it remains the case that the fees are now payable by the lender rather than the customer.
All right. Well, can I, Flora? Sorry, I'm going to bounce around a bit. I hope that's all right. But there was just a really specific set of questions. As we predicted before we got on the call, we were saying how just complicated all this is. So one person writes in, and this might be a question, it might also just be a sort of point for the CBI to-do list. Alagon writes, for those companies which fell through the safety net, i.e. small limited companies with only a director who could therefore not access furlough, the bounce back loans have been their only income. Where they are still not able to restart, they have no income and hence no option but to default and hold the business. What can be done to support them, and what can the CBI do for them?
So that particular scenario, if they have a bounce back loan and that's been their only source of getting access to finance during the disruption, then they've got the pay as you grow facility, which is that very formal framework to give them flexibility to pay back.
So I don't think that's the question. I think the question is, what happens if they need to get further finance to get through the next 6 months because their sector's not reopening or fully reopening, and they need further finance?
Again, this is the debate. They would then need to, if they could then look at the recovery loan scheme, if they can afford to take on more debt. They would have to talk with their lender to see if they can take on more debt via the recovery loan scheme. If they can't, then they are in a very tricky wicket, and that is when they will have to look at other financing solutions and really educate themselves and perhaps look into sort of equity solutions around that. I see Alice, my colleague, has posted up some information around equity finance. And the British Business Bank has got a really fantastic hub and very basic information around the ranges of finances that businesses can look at. This is the time, if you're particularly in those sectors where you've had no income or you've had to shut down 3 times now, you really need to spend the time to educate yourself on your financing options. You can't just be talking to 1 or 2 providers. You need to be looking right across the piece and considering the way forward.
I'm just going to come to Alex. You have a point to follow up on Flora, and then I've got an awkward question for you.
Yeah, I think what Flora mentioned then is that actually businesses don't necessarily need to educate themselves. They need to find some really good advisors. You know, there are people like myself, intermediaries within the finance industry, that understand the whole of the market. We spent the last 12 months understanding what's going on. We've been really at the forefront of helping businesses, but it's also something that we've done for the last 10 years and longer in lots of instances. So rather than trying to educate themselves, and often, you know, we're all very intelligent, we can all try and understand, but the complexities with each different product and understanding the nuances between what it stops you doing in the future versus what it allows you to do now, and just working really closely with intermediaries, your accountants. We all work closely together anyway, so there's an opportunity there for businesses to, you know, reach out to intermediaries and people that can actually advise.
So Alex, in that spirit, I'm going to reach out. So the awkward question is this: someone's written in anonymously to say, what would you say to a business that was excluded from the government loan schemes because of their sector, that had to take a commercial loan where it has to pay £3 back for every pound of the loan? And if you can't speak directly to that instance, I just wonder how much of that do you think is going on?
Well, I would question why they weren't able to take access of the government loan schemes, because the assessment for the government loan schemes was, even with the banks, you know, was about whether or not the business had been interrupted and whether or not they could pay it back. Now, we have seen throughout the last 12 months that it's been quicker and easier for a business to access finance via the alternative finance space and peer-to-peer lending, and in that instance many sectors have been excluded. You know, retail, leisure, hospitality, they've excluded those as part of their own lending parameters. However, the UK banking industry has really supported those sectors. So they may have required jumping through a few more hoops. It may have taken a little longer, but actually they may have gotten to the point of accessing that CBILS funding. So because I don't understand which commercial lender they've gone to and actually what the scenario is, I can't comment directly, but I would have suggested really working with the bank in the first instance before looking elsewhere.
Okay, thanks, Alex. Stephen, can I ask, there are a couple, these are a couple of questions sort of vaguely related. One is about potential changes to LIBOR and how this might help borrowers, but then there was also a question which came really quite early on, which was from Simon Jones, which was about inflation and what we think the extent to which we're going to begin to see inflationary pressures and then how that might play out. So would you do both that, LIBOR and inflation?
Yeah, sure. The announcement was made last week that LIBOR for sterling and for many terms of international currencies will come to an end at the end of this year, which means that, you know, not only do new facilities have to be written against another benchmark, and that could just be normal bank rate, base rate as we tend to call it, or a facility, a benchmark called SONIA in this country, which is very well established and is increasingly being used by the larger end in the derivatives markets and the bond markets.
Sorry, Stephen, what's SONIA?
SONIA is an alternative rate to link your lending to. Tends to be used for larger facilities and is very common now in the bond market and so on. Will be a bit of a replacement for LIBOR. It works in a slightly different way. But we've also just about to pass a milestone at the end of this month, after which no new facilities ought to be written against LIBOR. So, in order to kind of get on the journey towards the end of LIBOR completely, then at the end of this month, lenders will be talking to you about alternative rates to LIBOR. By the end of the year, we should also have made very substantial progress with changing over existing facilities, which go over the year end, so that they're actually migrated and transferred onto a different basis. There will be a few loans that are quite difficult to move because the contracts make it complicated, or logistically that's very difficult. And those, what we call tough legacy cases, may have to have alternative means to be managed. But vast majority of customers will hear from their banks, about the new rates and facilities. As I say, at the small business end, it's already very common for businesses to borrow at a certain rate over base rate, bank rate, which at the moment is 0.1%. So, it may be that one is the most commonly used. On the question of inflation, shall I move on to that, James? Yeah. I think it's quite difficult to predict, actually. At the moment, we're really concerned, aren't we, that quite the opposite of inflation, we have a very slow level of growth, and we're stuck in this kind of deflationary spiral that has been the picture in Japan for 20 years. But if you look at what a lot of the markets are saying about the US now, with the very substantial stimulus which has just been agreed by Biden, we may well see, actually, as things begin to go back to normal, with all of the injection of cash by central banks into the market, a pickup in inflation again. So I think actually this is quite difficult to predict, and it is possible that we'll begin to see prices rising again. And I think, if the recovery is rather fragile, central banks will be cautious about kind of calling that to a halt by raising interest rates too early. Governments will be nervous about, pulling in the reins fiscally too quickly. So they may be tolerant of inflation going above target, which, as you remember, did happen a while back, so that inflation is over 2% before coming back into line. What does that mean for businesses? I think, if they aren't able to pass on the increases in costs they're beginning to see, if imports are costing them more, potentially with all the pressures that are currently on them with disruption through Brexit, for instance, in higher transit costs, warehousing costs, and all the rest of it, that's going to add to the pressure on their profit margins.
Stephen, thank you. And Alex, Stephen, thank you both, actually. It's been absolutely fascinating, not just for getting the big picture, but also some of the detail. Flora, I just wanted to finish up before I go back to Matthew, finally, just with one thought from you. When the loans were rolled out, we were really keenly aware of certain sectors of the market. I remember the middle market for a while really being stranded. There was a lot of talk about bounce back loans and grants. CBI was involved in that. In this repayment phase, is it the case that bigger companies are looking sort of stronger and this is an easier thing to process, and it's smaller companies, or is there a middle market section? Are there segments of the economy that you look at and think this is really where we need to focus our attention?
I don't think it's to do with size. I think that particular issue we had with the mid-market was fixed with the large CBILs, and government responded very well to that. I think it's going to be, as Alex and others have said, about the individual firm and where they find themselves and the state of their balance sheet and their ability to take on more debt. That's going to be the issue. So it's going to be those sectors that have really been acutely impacted, and that's where our concerns are. And of course, that's where my colleagues in the economic policy unit here at the CBI will be working around other fiscal measures, other support measures that we can be dialoguing with Treasury around to support those businesses. Finance is not going to be the only way that we can support those businesses and help them to bear with us. What we don't want is we want to kind of many of them were viable and profitable businesses, and so therefore there's we need to get them back up again when the market's open. And Treasury know that. Many have gone into hibernation mode. How do we wake them up again, and how do we support them until they're ready and the market is there for them to open up again?
Thank you, Flora.
Big challenge.
Big challenge, no doubt at all. Well, listen, I should just say I'm going to hand back to Matthew. Matthew, I know that lockdown does strange things to people. If you were on the call with me and Ray Newton-Smith, the CBI chief economist, a couple of weeks ago, I found myself getting unhealthily excited about government's tax day. I know that it's upon us this week, and on Wednesday at the CBI at 10, Rain will be there, and Clifford Chance and you leave from PwC. So we'll go through tax day on Wednesday. What else is on the CBI to-do list this week?
Well, James, a few things just caught my eye. One is this pointer I mentioned right at the start about if we can expand workplace testing to include home-based testing. That's really important for us, so we'll be pushing that point. I think also the return to office and return to workplace piece is hotting up rather. So I think even though the roadmap guidance is really clear on that, I think we'll be out pushing government to get some more messages out on that. And then the final thing for me this week, James, is this whole piece around certification and so on, which again I think is in the news. I think companies are very mindful that that is a bit of a minefield. So if we're looking to entertain any of that, again pushing for really clear guidance on that, I think will be part of the to-do list for this week.
Okay, cool. Well, keep us busy. Okay, well, listen, thank you very much indeed. A big thank you to Alex Beardsley at ABL, to Stephen Pegg from UK Finance, and the CBI's own Flora Hamilton. It's been a great and fascinating conversation. Thanks very much, everyone. Have a good day and a good week.
Thank you.
Have a good week, everyone.
Thank you.